Hello everyone, my name is Balaji Nedurumalli and this is a presentation on the company analysis and some suggested methods to optimize your stock portfolio. For the goal of the project, uh, there were 18 companies selected and finalized from various industries just to make it diverse enough, and the industries selected are such as contractors, technical services, oil and gas, application software, health services, and beverages. The goal is to determine the best company to invest in. For this, I have used a process of elimination wherein I have some key statistics that I use in each and every step, and the companies were analyzed in each step based on these key statistics. And at the end of each step, the companies that are inferior are eliminated. The personal risk profile dictated the order of key factors that are evaluated. By this I mean my personal profile in the sense my age, my income, and all these factors determine how you would invest in stocks and how aggressive you can get. Where people could be more conservative, or some people can be more risky. So the companies selected are as below. These are the 18 companies we have selected for the analysis. So without reading them out, I'm going to move on to the strategy. My preference is based on my personal profile, and that would be high return stocks. My main focus is on high return stocks. So to pursue this analysis, I have prioritized my elimination factors. And the first step, I would look at the profitability of the companies, and primarily I'm focusing on the profit margin and return on equity. And I have used DuPont analysis to just support my return on equity theory, and to see what is really driving the return on equity. So I just wanted to make sure there are not any adverse factors that are ignored, and that will result in me selecting a company with high return on equity, which is not necessarily a good thing. So the next step, I was looking at the economic value added. And what this means is a company has to make money after it pays off the capital costs. So you just cannot look at the return or revenue and then imagine the company is doing good. If there's a lot of capital expenses or capital cost expenses for the company, making more revenue really doesn't help it. So for step three, I've looked at the liquidity ratios and how liquid the company is to be able to meet its debt obligations or the expense obligations. Following, I have looked at the market ratios of each company, such as the P/E ratio, beta, and the standard deviation, which is also the risk at which the stock price moves. And at the end, I have also looked at the debt situation of the companies. So we don't want to pick any company with a lot of debt. That's definitely not something I would like to. I'm not comfortable investing in. Okay, so the key profitability ratios that I am looking at is the return on equity. So what is return on equity? This would be the amount of net income returned as a percentage of shareholder equity, and it measures the profitability and indicates how much profit was made from from the investment from the shareholder. So this is very important and primary factor in my analysis, because ultimately the goal of the company is to maximize the shareholders' expected revenue or return. So there you see the formula for the return on equity. And the profit margin is another primary factor that I'm focusing on. which is a measure of the earnings for every dollars that were generated on sales. So just because there is a lot of revenue annually, it doesn't mean that there's really much to the company unless the profit margin is significant. So you really want to make sure the profit margin is high along with the combination of high return on equity. So let us say a company is actually in loss. In this case, the profit margin really doesn't matter anymore because uh, profit margin is only profit, no loss. The asset turnover. So as a secondary factor to the return on equity and profit margin, I have also considered to look at the asset turnover of the company just to get a good warm fuzzy feeling of how efficient the management is to use the assets of the company. So we just want to take a look at the asset turnover quickly, not to just support a little bit more on our profitability theory. Moving forward, I started looking at the data, and what I did, I chose the companies that made the top 10 in profitability, which I averaged from the year 2011 to 2013. So the reason why I chose the average is because since I'm just looking at high earnings companies, I just wanted to see a top, a thought by descending of the average return on equity, and I compared it with the thought by descending of the average profit margin. So that way I can see what companies show up on both sides. So here, as you see, the ones in yellow happen to be among the consistently among the top 10 of the average return on equity and the average profit margin. So I feel there is a strong correlation that a company that is showing up on both sides has good profitability, and there's definitely a high revenue return or high return. So I I chose to pick six companies out of the 10. I still wanted a good enough sample. I didn't want to get into the conclusions too soon and just make a less sample out of it. So I chose to pick six versus three or four. So those are the companies that I have eliminated in red, and the remaining companies are Coca-Cola, Caterpillar, Deere & Company, Intuit, Monster Beverage Corporation, AT&T. So my next step of elimination would be based on the economic value added. So this is the formula for the economic value added. So it is typically the net operating profit after the taxes minus the invested capital into the weighted average capital cost. So the weighted WACC is pretty much the interest that you have to pay for the shareholders' investments and the liabilities, current liabilities. So the capital is not going to be free of cost. You have to pay. You really have to. It comes at a cost. So I just mapped out into the graph the six companies that we are left with to see how they're performing in terms of economic value added over the 4 years. So as you see, negative EVA with good profit margin and ROE indicates heavy cost of invested capital. We definitely don't want to pick companies that are having high costs of invested capital to deal with because it's not getting into the actual profit. So CAT and E are eliminated because of their expensive capital. As you see, CAT has consistently had negative EVA for 2010 and 2012, and comparatively D is not looking so good. So I chose to eliminate these two. For continuing forward, I'm left with four companies: the Coca-Cola, Intuit, Monster Beverage Corporation, and AT&T. So what I was looking at next is the liquidity. So what is liquidity? How soon the company can generate cash to pay off its obligations. And my focus on certain ratios, the current ratio. It's the company short-term assets readily available to pay off short-term liabilities. So you want this to be higher. The quick ratio, the difference between current and quick ratio is that quick ratio excludes the inventory, and that way it is a more solid evaluation of the company's liquidity. So in this analysis of liquidity, I primarily focused on the quick ratio, and this is how the quick ratio is looking for all the four companies that are left out. So the average quick ratio over the period was calculated, and this is what I found. AT&T was way below expectations. I know the latest, the 2013 data indicated it had a less than one quick ratio also. So I was very comfortable eliminating AT&T, and it has been consistent over the 4 years. So I did not want to exclude Coca-Cola Company yet because it was not too bad on quick ratio. But then I chose, okay, why not take it to the next step? And the bigger the sample, the more accurate your analysis would be. So the three companies left now are Coca-Cola, Intuit, and Monster. My next analysis was the risk, which is the standard deviation, and beta. So risk is measured as the standard deviation of the stock price over a period of time, and the beta coefficient is a measure of the responsiveness of the stock to the overall stock market. So what that means is if the beta is greater than 1 for at a given time, what that means is the stock is more risky than the market, which or more volatile than the market, and beta less than 1 means it is less volatile or less risky than the market. Again, it is all a comparison to the market. It is not independent. And beta equal to 1 means that the stock is moving with the market. So it is equally responsive to the market, not much or not in the opposite direction. So negative beta means the stock is moving in the opposite direction of the market. So the market goes up, the stock goes down, stock goes up, market when the market is going down. So I just captured some screenshots from the Bloomberg just to show some values of these three companies so we can analyze closely. What you see here is for Coca-Cola, if you see the equity is 83% by weight and the debt is 17% by weight, and about 17% debt is not too bad. It's got quite good equity. And if you come over here, you can see the beta values, and the p-value right here is 0.875. So this is a p-value when the stock and the S&P are the X and Y variables. So what this means is it's not statistically significant when you compare to the S&P index, when you want to correlate the stock's movement with the S&P index, in other words. So moving on, we have the Intuit. Intuit has 97.5% of equity, and the debt is just 2.5%. So they are taking advantage of leverage, but not really as much. But I guess a lot of equity means the cost as you see, 2.9% cost of debt is very low compared to the cost of equity. So I think they could use more leverage, and I think they would definitely benefit using more leverage. Okay, now moving on to the p-value. It is 0.288, again indicating when we have the S&P in the x variable and the stock price in the y variable. As you can see, the stock has consistently been growing, but it is not statistically significant in comparison to the correlation between the S&P index because of the p-value suggestion. So moving on to the Monster Incorporated, you'll be surprised to see 100% of their equity means no debt. They're not taking advantage of debt at all. So there's 0% debt. As we saw earlier, debt was costing so low. I do not understand why Monster was not taking any debt to its advantage. But I wouldn't know why. But that doesn't bother me too much. It can only get better. It's already good as I see the other numbers. So if they can take advantage of debt and to further magnify their gains, it would be great as a investor for me. So again, looking at the p-value, it is 1, which is way more than 0.01. So indicating there is no statistical significance between the stock price to the S&P index. So moving on, this is my final analysis. So all the greens indicate good stuff, and the reds I really want to avoid. Although not necessarily that it's a comparative statement among the 3 finalists. But what I notice here is the return on equity is really good for all 3, and Monster is as good as Coke, but it's still higher. Average profit margin is more for Coke compared to Monster, which is Monster still has a good profit margin. Equity multiplier, which is the debt data on Coke. It has 2.6, which is higher than the other 2, but it is still not too bad, but that's not like a primary factor in my decision making. The quick ratio, look at Monster. It has 3. Like it has a lot of cash. It's very liquid. The beta, not really playing part in my decision making. The P to E ratio, as you see, Monster has 33.89. With that return on equity and profit margin, if the market still expect a lot from Monster's performance, I'm sort of directed towards Monster. The risk, which is what is playing a critical role in my decision making. If you see, it is 0.014 for Monster compared to, it is about 100% more risk compared to Monster. I mean, again, we have to talk risk in terms of the return, but if you were to plot this ROE and standard deviation in a efficient frontier chart, the performance of Monster would be outstanding compared to the Coke and Intuit. In conclusion, a general rule of thumb: there is no formula for optimizing a portfolio or to pick a stock. I personally prefer my portfolio to be diverse, and I would distribute my investments in these final 3 stocks that I chose. But for the sake of the project, if I were to pick just one stock out of the 18, which by the way I would not recommend, I would choose and go with Monster Beverage Corporation. I hope you all learned something from this presentation, and Thank you very much.